Hi, welcome to the Wealthy Wallet. My name is Monika Hengesbach. I'm an enrolled agent, NTPI Fellow, and CEO of Decision Financial Services. For those of you that had the opportunity of watching my last podcast, I had Aron Phillips on. He's an attorney and owner of the law office of Aron Phillips, and he gave us a ton of valuable information what new entrepreneurs or business owners should watch out for legally and try to protect themselves from unnecessary legal pitfalls that could happen to them. But one of the things that he talked about was entity structure, because that's something that both he and I get asked a lot by every new business owner is, what entity structure should they be in? And legally, it's very easy for an attorney to say, let's set you up in a limited liability company because it's less legal paperwork. They're great starting points, but tax-wise, they don't really give you that much benefit during in the taxes. And so I wanted sort of to expand upon what Aron talked about and really go more in depth into each entity structure, what you can and cannot write off. Now, mind you, in this podcast, I'm not really delving deep into all the strategies because there's a tremendous amount of strategies these entities can have, but I'm just giving you the very common strategies that one can write off just by making a very simple tweak. So first I want to go over is the different type of entities. And as the slide shows that there are 4 separate types of entities. There's a sole proprietorship. And basically what that is I started my business, I put the shingle right on the front door, and now I'm starting business. You know, those are very easy. There's no legal paperwork that has to take place, but they're also very risky. And why? Because you're it. Everything that you owe is up for grabs. There is no legal liability protection. They are subject to self-employment tax. Self-employment tax is 15.3%. They do qualify for that QBI deduction, which is a qualified business interest deduction, which is 20% of the profit. You are the only investor when it comes to ownership of the sole proprietorship. You can receive help from friends and family, like funding and things like that, but those would be considered loans or gifts. But when it really comes down to the legal aspect, you're it. So the LLC is the very common one. And what I say, this sort of bubble wraps you personally from protection. It's a great foundation in any starting business. It's flexible. It offers liability protection. It's really great for brand new businesses. You can have unlimited members in it. And depending if it's 1 or 2, if it's just 1, in the IRS terminology, it's considered a disregarded entity. It doesn't file a separate tax return. If it's 2 or more, it's called a limited liability company, aka partnership, for other lack of a better term, and it would file a separate tax return. You are limitedly protected, which means if you were to ever be sued, now I'm not an attorney, so now I'm going to throw out the caveat that Aron always did. I'm not an attorney. But my understanding of this is that if sued, they can only sue the assets that are owned by the LLC, that everything that you own personally is not up for grabs. It is subject to self-employment tax. So it is subject to that 15.3% tax. It does qualify for the QBI deduction. You can have unlimited members help. So, for example, I love LLC structures in the fact that for real estate, because in the case of real estate, and it's a different type of income, you can have many investors that come in and invest into the property, and they just get an additional K1. It's a lot easier to sort of streamline. The next entity is an S corporation, and you can be an LLC legally and just have your LLC taxed as an S corporation. This is a great entity structure for smaller corporations. It allows up to about 100 shareholders. There is definitely a separate tax return that needs to get filed. The biggest difference between an S corporation and an LLC and a sole proprietorship is that you do not pay self-employment tax on the profit. And the reason why is You, as the officer of that S corporation, have to pay yourself what is called reasonable compensation. Reasonable compensation is one of these things that's sort of gray, right? Because everyone asks me, well, what is reasonable compensation? Reasonable compensation is what you would get paid to do that job if you were to be hired by a different company. It's a little tweak. And that is the fact that as owners, we're everything. We are CEO, we are the bookkeeper, we are the marketer, we're the janitor, we're the administrative, you name it. We wear all the hats if we're a smaller corporation. Well, there's a way to put that all into play based upon hours and determine what is reasonable. But that's a different tax strategy. That could be a whole podcast on itself. So I'm just going to leave with the fact that with S corporations, you definitely have to pay yourself what is deemed reasonable compensation. The final entity structure is a C corporation. And basically what that is just a standalone entity. It has its own tax rate. It pays a flat tax of 21% right now. Currently, there's been some rumblings on the House floor that they want to raise that from 21% to potentially 23 or 24%. I don't know how well that's going to go over. All the corporations seem to like this flat tax of 21%, but that is could possibly change. You have liability protection, so it's not limited liable. You have actual full-on liable protection. So there's quite a bit different on that. The one key thing that I'm going to point out in a C corporation, it lacks flexibility. So in an S corporation, as an officer of an S corporation, not only do I have to pay myself reasonable compensation, I'm able to take out what's called shareholder distribution. So I'm able to draw money out of my S corporation as well. When I'm a C corporation, I can't do that. I have to either pay myself a salary or a dividend. And it's that dividend that is gets us into that double taxation, right? Everyone says, well, if I'm a corporation, I'm going to pay double taxation. Yes or no? The dividend is where the double taxation is, because you can't write off a dividend expense against the profit of a C corporation. So let's say I paid myself $100 dividend and my net income on my C corporation is $20,000. I'm still going to pay tax on $20,000, not $19,900. And then because I paid myself the $100 dividend, when I file my individual return, that $100 is going to get taxed, hence the double taxation, right, if I'm the sole owner of my C corporation. So sometimes C corporations aren't necessarily the best structure for a smaller corporation. However, they do have different ability to write off certain expenses. And so depending upon your situation, they may be the best one for you. So the next slide I'm going to go to is a client, actually a client of mine that came in when I was originally doing some tax strategies with them. They're a real estate agent. So that's why you're going to see some things in here like selling expenses and staging expenses that not all business owners are going to have. But this real estate agent, she's single and she earned an income about $291,000. It was $292,000 worth of commission income. And she had her, normal expenses of advertising, continuing education, MLS dues, meals and entertainments, things like that, photography. And so she ended up having a net income of approximately $243,000, $44,000. One of the bolded line items in that slide is called rent expense. And I have listed there $1,841. This isn't what we call traditional rent. This isn't rent that she went out and rented one of those rent-a-suites, right? Or an office space. This is using the Augusta Rule. And I believe I talked about Augusta Rule in a few podcasts back. It's been a little bit. But what the Augusta Rule says is that if I rent out my personal space for 14 days or less, I can claim that as an expense on my business and I don't have to pay income tax on that rent that I paid myself because it was 14 days or less. The rules is that you'd have to pay yourself what is considered reasonable. If I were to go out and rent an event center in my area and that would cost me $1,000, well, then I would have to pay myself $1,000 because that's what's comparable. I couldn't go and say, oh, my business paid me $5,000 for it, because that's not reasonable. I can rent a space for $1,000 a lot less. So that's what that line item there is highlighted dark, is that's part of a tax planning strategy. And then, of course, they work from home, and we're going to claim the home office deduction of $4,500. I want you to remember this $4,500 home office deduction, because if you go to the next slide, which is my S corporation slide, you'll notice that the revenue is exactly the same. All the expenses are the same. The rent of $1,841 is the same. That's the Augusta Rule. But now I have to pay myself what is considered reasonable compensation. And in this case, based upon the revenue that my agent had earned, we were able to guesstimate an annual salary of about $151,000. The reason why this salary is a little bit higher, and I want you to keep that in mind, is self-employed health insurance. As an S corporation officer, the only way that they are able to write off self-employed health insurance is if they put it through their payroll. They pay federal income tax on that, but they don't withhold Social Security. They don't withhold Medicare. They don't have to pay payroll taxes on it, but they do have to withhold federal income tax. But then they get to write it off again on their personal tax return. And I think this is something, a little bit of a loophole in the code that they haven't caught up with yet. So we're going to continue to be able to benefit from that. So the salary that she was able to claim is $174,000. We have payroll taxes on that. What is payroll taxes? The company has to match your Social Security and your Medicare tax. That's the 7.65 half of my 15.3% self-employment tax. So half of that is a deduction as payroll taxes. Employee benefits of $43,500 is we established a solo 401k plan for my client, and that enabled her company to do a profit-sharing contribution into her 401k for that $43,000, because I think the rules are about $65,000 or $66,000 total we're able to contribute to our retirement plan. So what is she doing? She is using her business income to help fund her retirement for later. So basically what she's doing is saving money on her taxes now, utilizing her business, lowering her tax bracket, lowering her profitable net income, and putting more money away for her instead of giving more money to Uncle Sam. Then you'll see on that line that's highlighted reimbursements. Remember how I mentioned the home office deduction under the sole proprietorship slide was $4,500? Here as an S corporation, you don't lose the home office deduction. What it is, it becomes a reimbursable expense to you. That's a tax strategy. You'd want to set up an accountable plan. That accountable plan will reimburse you back for any business use of personal assets, i.e. automobile expense, that rent, home office, cell phone, anything personally that you may use for your business is a reimbursement and can be deducted in that accountable plan. The next slide is the C corporation. And as you can see on the C corporation, I still got the Augusta ruling of $1,841, but you'll notice that my officer's salary is down compared to the S corporation. And now I have an additional deduction on there called health insurance benefits of $7,500. That $7,500 is what increased my officer salary on my S corporation. When you're a C corporation, you do not have to have your health insurance benefits added into your officer salary. It's actually a benefit for the corporation, and the corporation gets to write that off. This is why when you're looking back at what are some of the personal needs for yourself, maybe it's a one-person corporation, I have to have a very high health insurance premium because either I'm sick or maybe my spouse is sick. I have a lot of dependents on my health insurance plan. I'm in a hire my wife so she can be part of the business just to enjoy the benefits of the health insurance, then maybe a C corporation would be the way to go, because then the C corporation can write off the health insurance benefits. You can put an HSA plan. You could put a child care reimbursement, medical reimbursement. You can have a lot of these plans added into the C corporation, and they will be able to, the corporation can lower it against its taxable income. Any of those benefits as an S corporation officer, unfortunately, would have to be added back into your W-2 and taxed at a federal level. And sometimes that's just not worth it. So the last slide that I wanted to go over is actually a summary. And this is a good depiction of exactly what entity is showing what taxable income. So as you can see in my sole proprietorship, they pretty much have taxable income of $239,000. My S corporation has taxable income of about $10,000, and so does my C corporation. There really is no changing between the taxable income of the S and the C. It's just the different things that we can write off. As you notice, as we go now down to the individual tax return on the sole proprietorship, there's absolutely no wages, because as a sole proprietor, we're unable to take wages. Everything is draws. But my S corporation and my C corporation individual tax return is going to show the wages. Now, you'll notice on the wage line item that it is less than what we wrote off above. As you can see in my S corp, it's $174,000, and I'm only showing taxable wages of $151,500. The reason for that is that solo 401k I mentioned. You're able to defer up to about $23,500 out of your paycheck that goes into your solo 401k. Your company gets to write that off, right? So hence the gross salary. But when it comes down to what is going to be taxable to you, your gross wages are net of that deduction. So as you can see, again, we're utilizing this client's business to help fund more money away for her for later, for retirement purposes, and lowering what her taxable income would be. It's the same thing on the C corporation. As you notice, the C corporation's wages were $166,000. The taxable wages that are being reported on her 1040 are $144,000. The business income, as you can see through the sole proprietorship, is the line item above. Same thing with my S corporation. But as you notice on my C corporation individual, there is no business income. That is because C corporations are taxed at a flat tax of 21%. We have the QBI deduction. That's that 20% of my net income. You'll notice as my S corporation, it's a lot less because my income is a lot less. Whatever my taxable income's coming over is a lot less. I have more on my sole proprietorship. We utilize this on the sole proprietorship for a traditional IRA, which is that $6,500 deduction. Now, we could have done a SEP, which is a self-employed pension. We could have done those type of items, but you have to be careful when you do a self-employed pension. It affects how much you can write off on your QBI deduction. And at times, having more of a QBI deduction versus putting more into a retirement plan saves you more money on taxes than putting more into the SEP. But that's a personal choice. Some people would rather pack their retirement plan for later versus saving the taxes on it now. So in this case, we just did the very basic of $6,500, so it wouldn't affect the QBI deduction. There's nothing on the individual, the S Corp 1040, and that's because she maxed out in her W-2 with the 401k. You can only have one retirement plan write-off. You can't say, okay, my company had this, and I get to write it off again, and I can have a traditional on my individual return. No. You can only have one retirement plan. I can get involved in all these other things, and I'm going to hold off because my next podcast is going to cover all this retirement stuff. And then on my C corporation, again, there is an additional IRA deduction here because it was written off under the C corporation. The sole proprietorship, they get to write off half of that lovely self-employment tax, which is at $13,000. There is no self-employment tax on my S corporation. There's no self-employment tax on my C corporation, so they don't get that write-off. As you notice on the self-employed health insurance, the sole proprietorship is writing off that $7,500 as self-employment health insurance, but my S corporation gets to write it off again. And that was that little loophole I'm talking about. Not only does it write it off in its gross wages on the S corp to lower its taxable income by that $7,500, I actually get to write it off again on my individual tax return. So to me, that's almost a double whammy. I get to deduct the $7,500 once again to lower my overall tax bracket. The C corporation, again, they don't get to write that off, right? Because it was a corporate plan, and it was written off to lower their taxable income on that. So when we get down to the bottom line here, we have adjusted gross income. My sole proprietorship is higher at 166. My S corp's about 152. And then, of course, my C corporation is just my W-2 now, because it doesn't have to deal with all this pass-through business income and all these other write-offs. So it has actually the lowest adjusted gross income. Single standard deduction is the $13,850. That doesn't change across the board. And then I have my taxable income. And so it's about $152,000 roughly for as being a sole proprietorship. My S corp is about $138,000. And then my C corporation is roughly about $130,000. When we get to the taxes, my sole proprietorship's about almost $30,000 in tax. My S corp's about $27,000, and then I've got taxes on the C corporation on just the wages of $24,000. Here's the kicker. This is what kills people. It's the self-employment tax. So my sole proprietorship now not only has almost the $30,000 in federal income tax, it now has to pay self-employment tax, and that self-employment tax is about another $26,000. So at the end, it's $56,000 that this client would owe the federal government if she stayed as a sole proprietorship. If you go to my S corporation, there is no self-employment tax. So her tax is the $26,000. And because we had wages, she had approximately $27,000 worth of federal income tax paid off. See what happened there? She was able to write off those gross wages under her S corporation. Those gross wages included the 401k withdrawal that she put in there that was not taxable, did not pass through to her personally. She was able to deduct the federal income tax, that lovely $27,000 that she's writing off or gets to go against her taxes. Her S corporation was able to write that off because she's claiming the gross wages to lower that overall profit. So what she did was she gave herself a write-off for taxes paid or withheld on her behalf through her S corp to lower her taxable income. So based upon that, as an S corporation, she would get a refund rather of $633. Compared to as a self-employed individual paying almost $56,000. When you get to my C corporation, that person's refund is a little higher. It's about $744 because all they're really paying income tax on are the wages that are being passed through to her. But remember, the C corporation is taxed at its own standing. And so it has that flat tax of 21%. So that burden of tax is $2,000 roughly. So really she nets out owing about $1,400. So in this scenario, for this particular client, the S corporation seems like the best strategy because she's going to get the $633 back. It definitely saves a ton of money from the sole proprietorship because that one was showing $56,000, and then on the C corporation, she would have owed $1,423. Now, there are other write-offs, there are other strategies that could come into place to lower this amount more. I think my very first podcast, I talked about hiring the children. All of these entities could have hired a child, right? The sole proprietorship could have had child wages if the child was 18 and below. The S corporation, the C corporation would have to have Social Security and Medicare tax taken out. But again, that could have lowered taxable income. So we still have a lot of opportunity to even get these taxes lowered by more strategy. But the key component is that just because you've been advised or your friends or your next door neighbor have all said, become a limited liability company, and even your attorney said, yes, why don't you be an LLC? That's the easiest. That's great, but that might not be the end game for you. You really need to meet with your tax professional, determine if that is the proper structure, the proper entity for your business, and can there be any tweaks that would help lower your overall taxable income? I know that's a lot, so I didn't want to add anything else, and I didn't want to make this very long because it's a tremendous amount of information in a short period of time. So again, like we've always mentioned, if you have any questions, any comments, to feel free to leave those once you've listened to the podcast, or you can always reach out to us at Decision Financial Services. My next podcast is actually going to have a financial planner on here, which I'm super excited about. And he will be better equipped to delve deeper into all those financial plans. I just mentioned a solo 401k. I mentioned briefly a self-employed pension. Well, there's there's defined benefits, there's annuities. I mean, ad nauseum, I could probably go on and on of all the different types of retirement plans. So it's going to be really wonderful for him to come on here and be able to go more in depth into those plans. Again, those plans are good, whatever your financial planner recommends for you. However, I highly recommend that your financial planner and your tax preparer get together and talk collectively about which financial retirement plan is best for you. Just like I recommend your tax preparer and your attorney get together to determine what entity structure is best for you. Because as you can see, all of this financial information intertwines. And at the end of it all three of those professionals should be having your best interest in mind and helping you save money on your taxes, as well as utilizing your business now to help provide you income when you're retired. So my name is Monika Hengesbach. I'm an enrolled agent, and thank you so much for watching this episode of The Wealthy Wallet.